Some interesting macroeconomic news today. China has announced their GDP numbers and they are at 8.1% in 2021, but in general a couple of indicators came out quite weak because China is facing challenges with their zero COVID policy, domestic consumption due to some slowing growth of that, and generally China has also not eased their monetary policy too much. But now China is in a situation that the inflation in China isn't high, it just came in at 1.2%, whereas in the US it's around about 7%. And so China is now in a position where they can start actually playing with the monetary policy in terms of pumping more money into the economy. So one way would be, of course, to decrease interest rates. So that's also the opposite to what the US is doing. Now the US is thinking about tightening the monetary supply and thereby also raising interest rates, and China could actually be cutting interest rates in order to get the economy flowing. And so today the Central Bank of China unexpectedly cut the borrowing cost of its medium-term loans, and so giving its economy more liquidity or cheaper access to debt. As China may now need to stimulate their economy, this rate cut, although been surprising, isn't a big cut, but at least it's something for the economy that is quite contrary to what the US is actually doing, as there is now this tightening environment. But there's also an interesting developing story here that Xi Jinping actually said that the US should consider how they are implementing these new policies, that they should not hurt, for example, the emerging markets who have lots of debt nominated in US dollars. And the Fed tightening could actually also have some bad implications on the whole world economy. And so basically the start of easing in China and also this comment by Xi Jinping could be maybe two reasons why central banks worldwide could start rethinking also their tightening policy again. Generally, we know that the markets pretty much like liquidity, but it's uncertain whether or not this step in China will actually even benefit Chinese stocks or the markets in general, since they're more looking possibly towards what the Fed is doing. So more money in the US, in US dollars, will rather lead to growth in the growth stocks than something happening in China. And what is also a negative for Chinese equities possibly here is worries about the economy. But I would argue that in an environment of slowing down growth, these tech companies should actually be doing quite fine, because they are usually producing higher growth rates and are actually having substantial gains in their market shares and the real economy, in terms of that their solutions are cheaper, more desirable, and also faster in the market. So I'm not sure whether or not such a downturn in the real economy will actually have implications on some of the growth names and tech stocks. But anyways, interesting development today on the macro side. Let me know your comments below, and then thank you guys for watching and see you in the next one.